Welcome to our monthly economics and markets edition of this IBKR podcast. I'm your host, Andrew Wilkinson. Joining me today, Steve Sosnick, Chief Market Strategist, and Jose Torres, Senior Economist. Welcome, both of you.
Great to see you, Andrew. Great to see you, Jose.
Hap-
Happy day after the Super Bowl to both of you.
Hi, Steve. Hi, Andrew.
Jose, let's come to you first. The unemployment rate for January fell to 4% in an unexpected turn of fate. What are the key takeaways from you on the January employment report?
Well, it was really a mixed report. You had really strong wage pressures, declining unemployment, and favorable revisions for the past 2 months. But when you look at this month, you actually had really narrow roster expansions, and you had one of the important ingredients of the jobs report, which historically has been a good leading indicator, a reliable one. The average hourly work week fell to 34.1. That's the lowest since March of 2020, the pandemic depth. And before the pandemic, you got to go back to 2010 to see a number that low. So what does the average hourly work week mean? Generally speaking, before employers look to trim labor, they tend to begin reducing hours first. So making some full-time workers part-time and maybe reducing some of the hours from the part-time folks. Also, some weakness in the report. Most of the gains came from private education and health services, government, which are three non-cyclical areas. Amongst the cyclical areas, you just had retail and other services really contributing meaningfully. When you look at finance, construction, manufacturing, wholesale trade, information, transportation, and warehousing, those segments barely added any jobs, right? They were somewhere between 100 jobs and 8,000 additions. And then you had leisure and hospitality, mining, professional and business services. Those segments actually lost jobs. Really strong wage growth, good headline figure, declining unemployment. But when you look at the composition of job growth, actually very narrow, not that buoyant. And then the work week dynamic, that was a unpleasant surprise.
If I may, Jose, the couple things in what you were saying. Number one, to me, you've had the hourly week, the month, the hour average hourly earnings rise by point 0.5 when point 0.3 was expected. Yet you mentioned that hours worked went down. To me, that's living the dream to some extent, right? You're getting paid more to work less. And so how do we reconcile those two? And I guess the second part of my follow-up would be how you should government showed employment growth. That's probably gonna start to spin in the opposite direction as soon as the next report. How much does that weigh on what we're seeing, what you're expecting going forward, I should say?
Well, the federal sector does make up a minority of government when you consider state and local, which makes up the majority. So I'm anticipating maybe a 20,000 drag on government overall going forward. So that could meaningfully begin to weigh on payroll growth. As far as the reconciling the average hourly work week and the wage pressures, I think what's going on, Steve, here, and specifically to leisure and hospitality, we've been seeing that sector begin to decelerate, and that sector is prone to cutting hours. When you look at bartenders, waitresses, waiters, bussers, those kinds of occupations, those jobs are notorious for cutting hours. So I think some of that activity is happening in those kinds of discretionary spending categories, whereas other areas are still seeing the robust paycheck growth just because workers are feeling the pressure of higher costs and elevated interest rate and the reduced credit availability.
Steve, let's stick with politics a little bit here. Last week, there were all sorts of announcements on tariffs. The market first tumbled, then it rebounded. Are we out of the woods from a political perspective? And what do you think it's going to take from here to move the market decisively, either up or down?
I I think right now the problem you have with tariffs is the messaging is so all over the place. The market isn't really sure what to expect. As we're taping this Monday morning, we're getting a bit of a relief rally. The
Mm.
reason, because on Friday, there was the president basically came out and said, we're going to be doing bilateral tariffs shortly. The implication, subtext was it could be as early as like that day. We wake up Monday morning and we find that there are indeed some steel and aluminum tariffs, but that's not what we thought they would go. That's not what we were expecting on Friday. And at some extent, does the market start to, is it's really going forward. What's the market reaction going to be? At some point, is it the boy who cried wolf? That he's always threatening tariffs, but never actually really implementing them in a meaningful way. So far, of all the threatened tariffs, we have gotten steel and aluminum, which is a rerun of tariffs we got before. And the tariffs on Chinese goods, which China responded only with fairly targeted measures. So the market really didn't do too much from that. Otherwise, we postponed Canada, we postponed Mexico. And so if you're going to throw these threats around, at some point, you either have to deliver or people start ignoring them. And I think from the market point of view, they're relieved when they're not when tariffs are not implemented, but the threat is always there. And that's just something we're going to have to learn to live with and the back and forth. And again, the fact that sort of we haven't fully recovered each of these bouts took the markets lower, they then recovered, but they didn't fully recover.
Mm.
That's something that I think we're going to have to wrestle with. And again, I think that becomes more of the broader economic picture, jobs, inflation, et cetera, and earnings from the corporate picture. But the tariffs are just lurking there.
Steve, I'm going to come back to you in a moment on inflation. It's a very good point. But before we do, Jose, we have got inflation data coming out this week. How important is it, given what happened to the labor market in January? How important is this week's price report for January from a monetary policy perspective? What are you looking for? What are the markets saying that's going to happen?
From a monetary policy perspective, I actually don't think it's going to be a huge market moving reports, I should say, because we have wholesale prices from PPI as well as at the consumer level from CPI. Price pressures in January were pretty tame. We didn't see any big increases based on the nowcasting tools that I see. So I don't anticipate they're going to move the markets much. But if you do get figures that are above expectations, of course, folks could extrapolate that into possible goods price uncertainty stemming from tariff policy. But alluding to what Steve just said, it seems that investors in the market alike are tired already of tariff talk and these kinds of jabs being thrown internationally. It's only been 21 days since President Trump reclaimed the Oval Office. And folks the general consensus is that the outcomes are going to be less than feared. And you're also getting an assist from the Treasury Department, one from Secretary Bessent appearing to be much more disciplined in his fiscal approach. And then with what's going on with Doge, government efficiency, as well as Elon Musk, that's been helping to cap bond yields and has spurred somewhat of a bond market rally in the last few days. This idea that the Treasury is going to be able to limit spending and incrementally balance the budget. Of course, there's a wide budget deficit, so we're a long way from there, but increments do help along the curve. And then also to try to reduce wasteful federal spending. So that's really been capping bond yields and really giving the president more breathing room in terms of issuing trade negotiations out there in terms of threatening tariffs, and then also the restrictive immigration policy, because the tariff and the immigration policy is inflationary, but it is being countered by those developments at the Treasury Department.
And meanwhile, Jose, I will say the Treasury Secretary put the kibosh on one of our best podcasts, the one that you arranged with Dr. Miran and Doctors Miran and Rabini, where they basically, I'm oversimplifying, and I please everybody should listen to the podcast, where they basically laid out their theory that the Treasury had been erring too much toward issuing short-term notes as opposed to longer-term notes and was artificially depressing interest rates by doing so. And the implication was that Scott Bessent agreed with this. And so the incoming chair of the Council of Economic Advisors is Dr. Miran. That was a hell of a get, Jose. Kudos to you for that. That was all Jose's doing. But meanwhile, when push came to shove, it was like, oh, yeah, you know what? Actually, with this policy, we're not going to change it. And we're actually going to come out and say we want to manage the long end of the curve, which is consequentially can be more difficult, but does not require the Fed. So I will say, I think that's part of the relief rally is that people had come around to thinking that the long end of the curve was going to see proportionally more supply, therefore reducing price, therefore higher yields. And we didn't get that during the quarterly refunding announcement last week.
Steven, sometimes I worry, that they're maybe stuck in a hole because if they start issuing some heavy duration at the auctions, then all of a sudden you could get some of those yield spikes that the former administration was trying to avoid. And the issue is, we saw this back in 2023. Once you get above 5 on the 10-year Treasury, that's really a psychologically painful level for
Yeah.
everyone, not just equity investors, also prospective home buyers, people out there shopping for automobiles or appliances. At 5% 10-year Treasury, it's really painful.
Let me drill down into that a little bit further, Steve. It's all well and good for Scott Bessent to say that we're going to try and concentrate on the 10-year area and we're going to keep the funding short. All well and good if you can anchor inflation expectations, but that's not what came out of the University of Michigan consumer sentiment survey last week. It appeared that the Trump honeymoon was perhaps over because in that survey, Steve, you can identify as red or blue, and the long-term inflation picture didn't look good.
It did not look good. It was actually startlingly lousy. I mean, we've
Mm.
pointed out many times before, I've run the graph various times on Traders Insight, and I did it on Friday, showing that over the long term, that 1-year inflationary expectation number that comes out of the University of Michigan is pretty tightly tied to gasoline prices at the pump. It's not 100%. The correlation isn't perfect, and you can argue there's a 1-month lag or a couple of weeks lag. There's some mystery to it, a little bit, but it was clear that 2 weeks ago the inflation expectations started to rise, and it was very clear from this last one on Friday that it was terrible. Now, as you drill down into the numbers, and I didn't have a chance to do that when I wrote about it on Friday, it was too quick. There's a big disparity between whether you're Democrat, Republican, or independent. The independents didn't change their views too much. Republicans didn't change their views too much either. The Democrats really started to view things much worse. So you do have to wonder how much of that is just people's political bent being reflected in there. And again, it's not a huge survey, so like anything else, there's plenty of room for error. But the fact that you saw consumer sentiment drop at the same time you saw inflation expectations rise dramatically, and without really having gasoline prices as the cause, that definitely raised some eyebrows. But and that started to put a damper on the market's move on Friday. The real damper was the tariff talk. I think when you combine the fact that you had, a jobs number that, in my mind, my immediate reaction was, and continues to be the reaction, is this does not incentivize the Fed to do anything. It does that's okay again, as long as the economy is reasonably strong. And, again, there was some inflationary aspects to the wages, but in my mind, that's the good inflation because it's really not, to me, it's not a terrible problem. If people are getting paid more, they can, from a personal point of view, we should all get paid as much as we can. I want to see that to some extent. So the Fed, from the dual mandate point of view, the inflation, I can't see, Jose, correct me, but I can't see them thinking anything other than this is about as close as we can get to maximum stable employment, at least for now. That could change. And Jose went into the reasons why it could. And stable prices didn't move us anything closer to stable prices. We'll learn more from CPI, but again, their preferred measure is the core PCE deflator, which still is running a little above their levels.
Mm.
So we're not going to get anything from the Fed. From an economic point of view, I always think that the stock market should be rooting for the economy over the Fed because realistically, that's what drives earnings. And so it wasn't a bad number, but the consumer sentiment was a head scratcher. And then, of course, the tariff talk, as we discussed, got everybody spooked a bit. So I think we're going to have to wrestle with this. And I keep coming back to the idea of we see that as a rule, both in the general market and amongst our customer base, buying the dip is a very popular activity. I will assert that one of the other places that dips should be bought is when you can be opportunistic about buying volatility. either as a hedge or as
Mm.
a speculative tool, because what we've seen here is when it does go down, it can go down hard. Uh,
And Jose, I'm still of the opinion that we might not see another reduction in interest rates. What about the forecast trader? I would be at odds with forecast trader, I think.
well,
What's forecast trader telling you both on interest rates and on consumer prices this week?
So the CPI, the forecast traders are expecting the CPI. They're in line with the Wall Street consensus at 2.9% year over year, month over month, 0.3%, core 3.1% year over year, and month over month, also 0.3%. And really, this has been a level that the Fed has acquiesced to. The Fed really hesitated to go all the way down to maybe 2.5% inflation, 2% inflation. We've been talking about it a lot, that March 2023 episode with the bank failures. Do you want 2% inflation or do you want financial stability? The Fed chose the latter very clearly. 3% inflation, in my opinion, is really good for equities because the Fed is off your back, but your earnings, which are priced nominally, catch a 3% tailwind, all else equal, just because inflation is 3%, right? 3% and 2% sounds like, oh, it's 1% difference, but it's a 50% difference. So 3% inflation, I think, is good for equities with the central bank that's off your back. But when you go to 4%, then the Fed can't stay off your back. And then all of a sudden you start having some problems. I think that's the risk with the trade tariff potential and the immigration restrictiveness that could drive up inflation. But I don't think it's a huge risk because the other domestic policies, as well as the things that are coming out of the Treasury Department, are serving to counter a lot of that upside inflation possibility.
Jose, thanks for joining me today.
My pleasure. Thank you.
Steve Sosnick, thanks for joining us.
My pleasure as always, Andrew. Great to see you guys.
Okay, don't forget to the audience to subscribe to our channel wherever you download your podcast from.
Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX.